Hello, everyone, and welcome once again to this week's Money and Markets Squawk Call, where we go around the horn with our editors to give you their insights on the happenings in the economy and financial markets for this week and beyond. Today is Tuesday, August 12th, and with us on the call today are Larry Edelson, Mike Larson, Don Lusick, and Doug Davenport. Larry, why don't we go ahead and get started with you? Obviously, a kind of a downside week last week, except for a reversal on Friday. I thought it was interesting that the American Association of Individual Investors found that bearish sentiment survey rose to the highest level since August 2013. Just based on a brief 3 or 4% correction is all we got. So that's a kind of I thought kind of interesting. What do you think about the markets here?
Well, bounce was overdue, and we got it. And as I said last week, I wouldn't be surprised to get close to the record highs and even see a nominal new high. But in my book, according to all my research, all my models, we're entering into a 10-month bear market. So I'm going to be selling into any rally, basically, and shorting the market. It just has to be that way. Markets need time to correct. Bull markets especially, they can't go on forever without a correction. And when they do go on for what seems like forever, that's more bearish than bullish. So I think we're done. You know, it's just a question of where the bounce ends, whether it ends here today or maybe a little bit higher. It looks like it might go a little bit higher, perhaps a pullback today, but I think we're done. And gold is looking good. Up, it's firming up quite nicely. We're up about $4.70 as I speak, $5. I'm looking for a climb up to about the 1370 to 1390 level for the next few. Probably simultaneous with another downdraft in the stock market. And interestingly, you know, the dollar continues to strengthen right along with gold prices, which is something I've been expecting. So markets are doing what I expected. That said, they're still thin right now. The volume and open interest in the markets is pretty low.
Normal summertime lull in terms of the volume, but let's see, at the top of the call you said you expect the correction in stocks to last how long approximately?
5 months now. And if we go beyond 5 months, then it'll turn into a 10-month correction.
Okay, so stretching into early next year then.
Well, to December of this year, and if we see a new low beyond December's low or whatever low is made during the next 5 months in January this year, then we'll extend the bear market into May. Bear markets tend to move in units of 5 and 10 time intervals, be it 5 or 10 days, 5 or 10 weeks, 5 or 10 months, 5 or 10 years.
Interesting.
So my models show that this won't last more than 10 months, worst case.
More than your average correction then. All right, interesting. Thanks for sharing that. Mike Larson, we saw some pretty good economic data last week. Jobless claims came in better than expected. ISM services and factory orders were also bullish. What's your take on the economy here?
Yeah, I think the economic news in the U.S. continues to come in just fine. Things are doing fairly well, but in the grand scheme of things, it hasn't mattered much for interest rates because the European economic data has stunk. And you're in this sort of global environment where, you know, what happens to our yields has been much more tied to what happens overseas than what happens here. So, you know, it's kind of weird, but it is the situation that we have. And so that's been a suppressing factor on yields, which are basically just kind of hovering around these levels, you know, 2.4, 2.5 on the 10-year. We briefly spiked below 2.4 on some of those geopolitical concerns, too. So obviously that's weighing on it. I mean, when you've got more attacks in Iraq, you've got worries about what's going to happen to Ukraine. You're getting still that flight to quality bid in Treasury, so that's kind of put a cap on yields. They haven't really mattered much with the U.S. fundamentals, so not a heck of a lot different there. But again, I think the Fed still has to respond to what's been going on in the U.S. economy vis-a-vis what's going on overseas. So the one thing that has worked out very well for me is being short euro. I've said that the U.S. and the UK economies are in a different world than the ECB, the Eurozone is. So in that kind of situation, you can continue to see pressure on the UK and US central banks to raise rates and get out of QE, even as Europe continues to try and go further down the path towards that, towards Euro QE or whatever you want to call it. So in that situation, I think the euro currency is vulnerable, and indeed we've traded all the way down from a peak of just under 140 to about let's see, what was today's low, 133.30 here. So if we break these levels, this is a pretty significant technical area of support, in my opinion. If we break down, not much below 133, we're probably heading to 130. Ultimately, I would expect to see something in the mid 125 area on euro. So that's one thing that's worth keeping an eye on here. But again, I think the U.S. data has been decent. The economy here is in decent shape. Many of these indicators, like I said in our last call, are at levels they haven't seen since 2006, 2007, 2005. Just pick an indicator and you can see those numbers are go track back all the way to those levels. So, I don't really agree that the U.S. economy is going to stink until the end of time, which has kind of become the conventional wisdom. But we'll see.
Thank you, Mike Larson. Great insights. Don Lusick, why don't we go to you? We're pretty much at the end of the second quarter earnings reporting season. Results have been pretty good so far. What's your take on that?
Yeah, I agree. I think something like 3/4 of companies reported upside earnings surprises, and just like we've seen in the past couple of years, I think. You have a little bit of softness or not as much robustness as you'd like to see in the revenue numbers as far as like beating expectations. I think we still have them, more than half, and low 60s, mid 60s percentage companies have been beating on revenues. What I have noticed is where, so that's one thing. So we're still sort of, it's this plug along economy that sort of taps the strength from companies in terms of revenue growth. I think I said on a call a few weeks ago that a little inflation could be a good thing here. Economically speaking, if companies are if they have some sort of unit production or unit sales slowdown, price increases can offset that. We really haven't seen that. So that there is still that risk. But it's funny because the bond vigilantes do not want to see inflation, but frankly, from a fundamental perspective, you kind of want to see a little bit, in the Fed's range or a little bit outside it, the 2%-ish, low 2s kind of number. You kind of want to see that, and we haven't really seen that. Any uptick in inflation, and I think that's what's in the Fed's mind, is that they can keep things going, in an accommodative stance for still quite a while here. I know that there are some concerns out there in the blogosphere and the financial press and opinion financial opinion makers like ourselves. There is some concern out there about strength of consumer spending and can it keep on going on? My response to that is sort of, you never bet against the American consumer. We're really good at spending, so, in a nutshell, I wouldn't worry too much about that. What have we seen in earnings season other than just sort of, a good earnings beat quarter, not great revenue beat quarter, because you'd like to see that low 60s% nearer to 70 to really say, okay, well, things are back on track. So things are not back on track 100% just yet, but I think that we're just still sort of muddling through here. What I've noticed as well, a couple of things I've noticed as well. Energy, the stocks still have been really kind of, I think a lot of energy investors or a lot of energy sector investors have been a little freaked out about what's going to happen in 2015, 2016 if the global economy loses its footing. But I think that those are just sort of like wall of worry kind of items, and what I'm seeing from the earnings this quarter from energy have been fantastic. I mean, they've been really, really strong. I haven't heard too much in the way of long-term weakness or medium-term weakness or anything like that that would really drive it. But but there have been some sell-offs. Healthcare as well. Healthcare has been posting very good earnings numbers, but I think that there's some doubters out there, or maybe for individual stocks. I don't know if there's an overbought condition for individual stocks or not, because I don't really use that kind of analysis. But if there is, I think that might be the case here. So those two things are very emblematic of sort of a larger theme. If there's a theme to be pulled from Q2 earnings season, is that earnings beats and sort of good news, better than expected news, has been rewarded by a bid. So investors bidding up the stock prices, but it's been a really weak bid. And on the other side, you have those that miss earnings expectations or revenue expectations. They've been getting absolutely crushed. So it does seem to me that just indicates a more selectivity by investors at this point, because there is this sort of uncertainty. And you typically see this when markets just sort of like run up without the support, the fundamental support. And we saw that earlier this year with the Weiss ratings, where the ratings were deteriorating in overall bullishness as the market was going up. And that's usually a yellow flag for us. We saw some bottoming in the ratings. I've seen some glimmers of hope in healthcare, but that's the healthcare sector is one where I think you might have some landmines here going forward because of repercussions of the new system in place, the Affordable Care Act, aka Obamacare here in the U.S. is the big one. Who knows? It's a political season, so who knows how that act might get affected in the near future. And so I think that there will be some trepidation on the part of investors going forward because of expected changes and unexpected changes to payments, revenue payments for these firms in the healthcare complex. That's one thing that you should be careful of, but I still think that there are some really good stories in there, and I do think that we've seen some improvement in the ratings in the healthcare sector. Energy continues to be pretty solid despite some disappointing stock performances. That may be a spot to look at. And finally, circling back to what I was saying earlier about consumers, consumer discretionary stocks is doubted. They're always doubted, and in layman's terms, never count them out. Consumer staples, there are some warning flags. Look at the food-related companies have been getting hit here recently, so I'd use some caution there. Other than that, I think that it's still, pick news, get more exposure to pro-cyclical names. I think that any pullback here will not be the momentous 10% plus pullback that some of the more skittish investors are envisioning. I know you don't get to talk much on these calls, and I was wondering if you had any congruous or incongruous thoughts with the rest of us this week. I mean, what are you following?
Well, I'm following the market's trends pretty closely, as I think we all do. As Doug mentioned, the trend is.
Do you see a setup here for a correction?
Well, I certainly think we're overdue for a correction. I totally agree with what Larry says, and on that note, that we're, markets have a very strong tendency to be mean reverting over the long run, right? So when you go,
we've had almost 3 years here without a real one, right?
right, when you go that long without a meaningful correction, I think you know, it tends to, you tend to think it's overdue. But on the other hand, as you know, as Doug just mentioned, we saw the sell-off, you know, over the last, you know, week or 10 days. And all of a sudden, you get the American Association of Individual Investors survey gets extremely bearish, and you see investors last week pulled tons of money out of equity mutual funds. So I do agree that investors are quite a bit skittish, and usually when they are skittish as they are today, you don't get that big correction, right? When everybody's expecting it, you get it when they least expect it. So,
true.
So who knows? The most surprising thing might be that we just keep sailing on despite all the troubles in the Mideast and despite all the worries about Fed policy. Maybe the market just keeps rolling higher. Certainly, the earnings improvement and the upturn in the economic data recently tend to support that. So we will see. Doug Davenport, how about you? You follow the global trends pretty closely on multiple markets. What's your take from here?
Well, I want to follow up on what you said at the beginning of the call. You were talking about sentiment, and it really did turn extremely bearish in a very short period of time here in the last couple of weeks. And to me, it appears that why did the sentiment get so negative? Well, it appears there could be a couple of reasons, and I think people have been watching the market just too closely because we've gone, as someone has mentioned, a long time without a 10% correction. So many people got burned, obviously, in 2008, and they don't want that to happen to them again. And who knows? I think people fear that when the Fed unwinds their bond buying program, that we're all doomed. Well, I don't believe any of that. But whatever the reason that sentiment turned bearish, it seems that so many investors appear to have one foot out the door ready to get out of this market. And then what happens is that this nervous psychology is actually, I think, helping to keep a decent bid under this market. So I think that the psychology obviously is very important in the market, and when everyone is getting really worried and nervous, well, I think the bids have been put under the market right now. But if you look, the Russell 2000 last week as a positive note, it outperformed the S&P 500 4 out of the 5 days last week, and the Russell had fallen much further than the S&P did in the last couple of weeks. Now, earnings have been very good, as Don said. We've had a very attractive year for that, so that's not pulling the market down. And I usually like to do something that Sir John Templeton taught me to do every day, and that is when you walk in the office, the question that you should always ask yourself is, what do I know today about the market? Well, if you look today, the uptrend channel in the S&P 500 is still intact, even after last week's pullback, which tested, if you look at the chart, a 100-day moving average and the lower trend line that is a part of a channel that goes back through November and December of 2012. Now, the market, the S&P, has touched that lower trend line since December of 2012. It's touched it about 7 times, and every time it's pulled below that 100-day moving average and touched the bottom rail, it has bounced back to newer highs. Now, what we don't know is that if this bounce that we saw Friday and yesterday, is that going to continue to form a new high like it has the 7 previous times? Well, we don't know, and no one really does. But you've got key support on the S&P 500 right now at about 1914, and that held last week, and that's important because the next support down below that's about 1890 to 1910. Now, you've got the key resistance level that we need to punch through to reach that higher high. We're going to have to punch through about 1952 on the S&P 500, and I don't think that's going to happen today, though. So you look at August. So we've got 2.5 weeks left in August. You know, August is typically a very quiet period. Volume thins out as people are not in the office, so to speak, the traders. Headlines can move the markets in so many ways at this point in time right now. We certainly have a lot of things that can move the markets from a headline standpoint. Earnings season ends on Thursday with Walmart coming in at the very end. And then this week, not yet, but for the rest of the week, you've got a couple of Fed governors, Dudley, Fisher, and Rosengren, scheduled to speak this week. Now, 2 of those 3, Dudley and Rosengren, are certainly hawkish, so that will create some headlines for the market because they're going to be hawkish. And then you've got Fisher coming in, and he's probably going to give some dovish thoughts about what he thinks. Now, Regarding other markets, I'm still short the euro. You certainly have a slowing economy in Germany, Europe. The euro is at the lowest level since last November. And we've had a lot of selling in Italy and Spain and especially Germany over the last couple of weeks. And it appears the U.S. stock market has certainly not dropped to the extent that those markets have. And maybe that's because the U.S. market appears to be the best place if you're going to put some investment dollars to work as opposed to those markets in Europe. I'm very, very, very happy to have China in the portfolio. I'm long China. There's some very attractive individual equities in China, emerging markets still from a trend and a chart standpoint, but very attractive. India is very attractive also. Now, if you look at the dollar, the U.S. dollar bottomed in May, and that's probably a short-term bottom, but it did bottom in May, and that's been hurting the commodity prices quite a bit. Gold, I'm long gold right now. I still think oil is still attractive, and gold is trapped in, I think, this narrow trading range between about 1280 and 1340 on the upside. It's a little rectangular box that has not decided which way it wants to go, up or down. Oil is much in a similar situation. Bonds through TLT, the 20-year Treasury ETF, that's still very attractive. I've owned that since January. It's up over 15% for the year to date, so I am very happy with that. And for equity sectors that I have in portfolios, like basic materials and energy, those are two of the top three performing sectors this year, and both are very attractively priced. And of all the sectors in the S&P, of 9 of them, basic materials, to me, is the most attractively priced, and has been, and along with energy and energy services, have been outperforming the S&P by a wide margin this year. So, in summary, my views could kind of be boiled down to the fact that the market has not made its intentions clear yet about whether it wants to go to be a bull and go over 1954 or whether a bear scenario is going to play out. And we just have to wait for price action to show us each day what that's going to be. So I think for the next couple of weeks we're going to see a market that is certainly headline driven and a lot of choppy market action with no real trend, even though the intermediate and long-term trend are still up. And I think the S&P is going to trade between 1914 and 1952 to 54 on the upside for the short time being. So the long-term trend is still up for the equity indices, and I have no idea when that will end, and no one has. A lot of people have predicted the end of that for the last 2 years, but we're still continuing up, so we'll let the price action determine what the market wants to do. And that's my thoughts for the week.
Well, thank you, Don. Indeed, the trend is your friend until it isn't, as they always say.
True.
Very good thoughts. I appreciate it, actually, one and all, and that wraps things up for this week's Squawk Call. As I said, great insights, one and all, gentlemen, and thank you very much for your time. And be sure to tune in again next week. Until then, I'm Mike Bernick for Money and Markets. Good investing.